Welcome to Earnings Recap. Today we're covering Warner Bros. Discovery's earnings report and call.
And quite a call it was.
Yeah, David Zaslav kicked things off mentioning that HBO is delivering, and this is a quote, "the deepest, most consistent storytelling pipeline in its history."
That's a pretty bold claim. Sets a high bar.
It really does. So today we're going to dive into Warner Bros. Discovery's latest financials, Q1 2025, and really just break down what it all means, in plain English.
Right. We're looking at their earnings report and the conference call that followed.
Exactly. And our mission here is just to get a clear picture of their financial health, their main strategies right now, and maybe what the future looks like for them.
Okay, let's jump into the overall financials then. The big number, total revenue for Q1 was $9.0 billion.
Okay, $9 billion. How does that compare?
Well, compared to last year's Q1, where they had $9.958 billion, it's actually down 9%, excluding foreign exchange effect.
Down 9%. So revenue dipped, but like you said, we need to dig a bit deeper.
Exactly, because when you look at the net loss,
right, the bottom line,
the net loss available to Warner Bros., Discovery was actually better. It was $0.5 billion.
Still a loss, but definitely an improvement from the $0.966 billion loss they posted in Q1 of 24. So moving in the right direction there.
It is directionally positive, yeah. But we have to remember that number still includes about $1.6 billion in pre-tax charges.
The usual suspects, like acquisition costs, amortization.
You got it. Acquisition-related amortization, content fair value step-ups, restructuring costs, things that aren't really about the day-to-day running of the business.
Okay, so maybe a better measure of just operational health is the adjusted EBITDA. How did that look?
That's where things get interesting. Adjusted EBITDA came in at $2.1 billion.
In compared to last year?
It was $2.102 billion last year, so this is actually up 4%, XFX.
Up 4%. Okay, so despite lower revenue, the underlying profitability seems stronger. That's definitely a positive signal.
Absolutely. Adjusted EBITDA filters out some of that noise we just talked about. So a 4% increase year over year points to better core business performance, maybe more efficiency.
Got it. Now, free cash flow, that went down, didn't it? To $0.3 billion from $0.39 billion last year.
It did. And they pointed to higher spending on content and also capital expenditures, specifically for expanding their studio facilities.
So investing back into the business, should we be worried about lower free cash flow?
Not necessarily, no. I mean, spending more on content and infrastructure, that can be a strategic play for future growth. They're putting money in now, hoping for bigger returns later.
Right, you have to spend money to make money sometimes. We'll need to watch if that investment pays off down the line.
Exactly. The proof will be in future quarters.
Okay, something else they highlighted was debt reduction. They paid down $2.2 billion in Q1.
Which is significant. They ended the quarter with $4.0 billion in cash, but their gross debt is still substantial at $38.0 billion.
So where does that put their leverage?
Down to 3.8 times net leverage. Reducing that debt load is really crucial.
Why is it so important for a company like this? Lower interest payments.
That's a big part of it, yeah.
Yeah.
Frees up cash flow. But it also just reduces their overall financial risk, gives them more breathing room. Investors definitely like to see that leverage ratio coming down.
Makes sense. And they also refinanced some debt, right? $1.5 billion due in 2026, swapped for a term loan.
Correct. And they expect that move to save them cash on interest payments going forward. Smart financial housekeeping.
Okay, so that's the broad financial overview. Shall we break it down by segment? Streaming seems like the place to start, given the momentum.
Agreed. Streaming revenues were up 9% XFX, hitting $2.656 billion. That's up from $2.46 billion last year. Solid growth.
And the subscriber numbers. They hit 122.3 million globally.
Yeah, that's a jump of 5.3 million subscribers just from the previous quarter, Q4. Pretty impressive growth rate.
That really signals that Max and their other platforms are connecting with people. What's driving that, do you think?
Well, one major factor is advertising. Their streaming ad revenue was up a massive 35% XFX.
Wow, 35%. So the ad-light tier, the cheaper option with ads, that's really taking off.
It seems to be a huge success, yes. It's clearly attracting a lot of new subscribers who are okay with ads for a lower price point, and advertisers are obviously seeing value there too.
But interestingly, the average revenue per user, the ARPU, actually went down. Global ARPU dropped 9%, and even domestic ARPU fell 5% to $11.15. How does that work with rising ad revenue and subs?
Yeah, that's the counterintuitive part, but it makes sense when you unpack it. Two main reasons. First, a lot of that subscriber growth is happening in international markets,
where prices and therefore ARPU are generally lower than in the U.S.
Exactly. And second, even domestically, the big push for the Max Basic with ads plan, while great for subscriber numbers, naturally brings down the average revenue per user because those subs pay less.
So it's a volume play right now, get more people in the door, even if the average payment is slightly lower for now?
That seems to be the strategy. Grow the base, especially with the ad tier, capture market share. The challenge later will be to nudge that ARPU upwards again, maybe through upselling or price adjustments.
But even with lower ARPU, the overall profitability of streaming looks much, much better. Adjusted EBITDA for streaming was $339 million.
Right, compared to just $86 million in Q1 last year. That's a huge leap.
So the scale, the subscriber growth, and especially that booming ad revenue are really boosting the streaming segment's bottom line.
Precisely. It shows their streaming investments are really starting to generate significant profit. That's a major positive takeaway.
Okay, let's switch gears to the studio segment. Revenue there was down 16% ex-FX to $2.314 billion. What happened?
Mostly it's a story of tough comparisons. Q1 last year was exceptionally strong for the studio.
Ah, right. What big releases did they have then?
They had the huge theatrical runs of Dune, Part 2, and Godzilla x Kong, The New Empire. So theatrical revenue this quarter was down 27% compared to that.
Okay, that makes sense. Any other factors?
Games revenue was also way down, 48% actually. Last year they released Suicide Squad, killed the Justice League in Q1. This year, no major game release in the same period.
So it sounds more like timing and the cyclical nature of blockbuster releases than a fundamental problem?
I think that's fair. It's not necessarily a sign of underlying weakness. And worth noting, their TV revenue within studios was actually up 4%, driven by selling more content internally, likely to Max.
Right. But here's the interesting part again. Despite lower revenue, the studio's adjusted EBITDA jumped significantly, up 63% to $259 million. How?
Cost control. They managed their cost of revenues much better this quarter, particularly for the theatrical releases and games they did have.
So spending less on production and marketing for the projects released this quarter compared to the big blockbusters last year.
Seems like it. Better cost efficiency meant that even with lower sales, the profit margin improved dramatically. A more disciplined approach, perhaps?
Interesting. Okay, next up. Global linear networks. Traditional TV. Revenue down 6% here to $4.77 billion. Not exactly a surprise.
No, not at all. This reflects the ongoing industry trend. People cutting the cord, viewership declining for traditional channels.
And the drivers are what you'd expect. Fewer subscribers, lower ad revenue.
Exactly. Domestic pay TV subscriber numbers continue to fall, which heads distribution revenue that was down 8% despite some price increases. And lower audiences mean lower advertising revenue, which fell 11%.
So the pressures on linear TV are definitely showing up in the numbers.
They are. It's a persistent headwind for this segment.
And consequently, adjusted EBITDA for linear networks was also down by 14% to $1.793 billion.
Right. Lower revenue flows through to lower profit in this mature part of the business. They're managing it, but the downward trend is clear.
Lastly, the corporate segment. Adjusted EBITDA actually improved there by $113 million.
Yeah, a positive swing to $233 million loss. This came from a few things: releasing some tax reserves, lower facility costs, maybe office consolidation paying off, and lower securitization expenses, mostly internal cost management and adjustments.
Okay, that covers the numbers in detail. Let's pivot now to the strategy side, the non-financial takeaways from the call. South Loves, it's not how much, it's how good mantra came up a lot.
It really did. They're hammering home this focus on quality storytelling, creative talent. He name-dropped White Lotus, The Pit, The Last of Us, the upcoming Minecraft movie, the whole DC slate.
It seems core to their identity now, prioritizing these big, high-impact projects over just sheer volume.
Absolutely. It's a bet that quality creates cultural moments, drives engagement, builds franchise value, and ultimately keeps subscribers sticky in a very crowded market.
And they seem optimistic about growing streaming further. What are the main levers they talked about?
Several key things. First, keep delivering those best-in-class stories, especially from HBO. Second, push harder on local language content and sports internationally.
Right, tailoring the offering.
Third, just keep expanding the global footprint, launching in new markets. And fourth, continue improving the Max product itself, the user experience, features, etc. It's a multi-pronged growth plan.
Makes sense. And for the studios, they have that big goal. get back to $3 billion in EBITDA. How do they plan to get there?
It rests on a few pillars. The strength of Warner Bros. Television production. A focused movie strategy mixing big IP blockbusters with originals. They mentioned Minecraft and Sinners specifically, and, of course, the big DC Studios 10-year plan kicking off.
And they mentioned Superman coming in July as a key part of that slate this year. $3 billion is ambitious, though.
It is. But they believe their IP library, their production capabilities, and the new strategy under James Gunn and Peter Safran for DC can get them there. They also stressed leveraging owned IP, unlike sports, which Zaslav called
a rental business, right? I caught that. That contrast between owning DC, Harry Potter, Lord of the Rings versus renting sports rights seemed very deliberate.
Extremely deliberate.
Yeah.
It highlights where they see the core long-term controllable value residing in the assets they own outright and can build ecosystems around. Sports are valuable, sure, but they're expensive and rights come and go.
Speaking of sports, their strategy on Max seems quite varied globally. Integrated sometimes and add on others. Still figuring it out in the U.S.
Yeah, they acknowledge they're still experimenting, particularly in the U.S. market, to find the right model for integrating sports without alienating subscribers or breaking the bank.
Okay, back to HBO. They talked about its secret sauce. What did they attribute that enduring success to?
Primarily, the experienced creative leadership under Casey Bloys and that core philosophy of quality over quantity we mentioned. Creating those cultural moments, shows people have to talk about. They cited the pit and the buzz around Euphoria's eventual return.
And that HBO brand, that reputation for prestige, is obviously a huge asset for Max.
Absolutely. It's arguably the anchor tenant for the entire service.
Interesting point on demographics, too. They said Max is connecting well with younger viewers.
Yes. Apparently driven by content that feels topical and creates that FOMO fear of missing out. Getting younger audiences engaged is critical for long-term health.
Definitely. And internationally, some good news. Europe is now net positive across streaming and linear combined.
That's what they reported, yes. And international overall is also net positive now. That's a pretty significant turning point, showing their global strategy is starting to bear fruit financially.
Okay, let's talk ARPU again. How are they planning to increase it given the current dip?
They outlined several levers. Continued growth of the ad-supported tiers actually helps overall ad ARPU. Then there's tackling password sharing. They plan to get firmer on that over the next 12 to 18 months, rolling it out globally by 2026, potentially with extra member options.
The Netflix model. What else?
But to take future price increases, obviously, upselling sports packages internationally where it's an add-on, and just driving more engagement overall, which boosts ad revenue per user. It's a multifaceted approach.
Got it. What about overall content spending? Are they planning to ramp that up significantly?
They said no major step-up is planned. Just a moderate increase to support growth in streaming and studios. Interestingly, they noted more of the content produced by Warner Bros. Is now being kept for internal use on Max.
Building asset value on their own platform makes sense.
Exactly. Strengthen the core offering, drive value directly.
But they are still licensing some content out, right? I saw examples like Scooby-Doo on Netflix, Ted Lasso on Apple.
Right, they have a selective licensing strategy. They'll license out library titles, especially non-core franchises, to generate revenue. Abbott Elementary to Disney was another example.
But they keep the crown jewels for Max. DC, Harry Potter, Lord of the Rings, Game of Thrones.
Precisely. Protect and leverage the absolute core IP exclusively on Max to drive subscriptions and franchise value. They also argued that sometimes licensing can actually increase the overall value and awareness of an IP. It's a balancing act.
Looking longer term, what are the big growth drivers they see for streaming?
Continued globalization, deeper penetration in existing markets, ARPU growth from all those levers we discussed, compelling content, product improvements, and bundling.
Bundling. That seems to be a hot topic everywhere, partnering with other streamers.
Yeah, they mentioned the potential for bundles with other major players. The idea is a better consumer experience, maybe lower churn, lower marketing costs if you package services together. Definitely something they're exploring.
And for the studio to hit that $3 billion goal, what needs to happen?
Success across the board, really. Continued strength in TV production. The new film strategy delivering hits, getting the game's business restructured and performing better. Better franchise management across the company, and smarter content windowing.
They sounded pretty confident about Q2 for the studios, didn't they? Called it a potential blowout.
They did. That sets expectations high for the next earnings report. We'll see if their upcoming slate delivers on that prediction.
One last thing. The macro environment. Did they see any impact from the economy on ads or consumers?
So far, they said no material impact. Advertising upfront discussions might be a bit slower, but the immediate scatter market is apparently strong. Consumer sentiment seems okay for now.
But they're being cautious, taking cost measures.
Yes, they mentioned taking precautionary cost actions, and they expect corporate costs to be down year over year.
Yeah.
So being prudent, but not seeing major economic headwinds hit their business yet.
Okay, so let's wrap this up. Key takeaways. Warner Bros. Discovery showing real progress in streaming growth and, crucially, profitability, still navigating the expected declines in linear TV, and a very focused strategy in the studio, leaning heavily on quality and their owned IP.
That sums it up well. Momentum in streaming, managing the linear decline, and betting big on their core franchises and content quality. Their ability to execute on that IP strategy seems paramount.
All right, here's a final thought for you listening. As the streaming world keeps changing, and we hear more and more about these potential bundles, how do you see your own subscriptions evolving? Are you leaning towards wanting a big, convenient bundle from maybe 2 or 3 major players? Or do you prefer sticking with your hand-picked individual services, curating your own content world? Something to think about as this all shakes out.